Another 9 FTSE 100 firms are due to report results in the week ahead, along with a deluge from the FTSE 250. So we can't pause for breath just yet, especially as we have 2 central bank meetings for this week for good measure. While neither the European Central Bank nor the Bank of Japan are expected to increase interest rates or switch tack on their quantitative easing schemes on Thursday the 8th and Friday the 9th of March respectively, analysts and economists will still be poring over their statements to see if there are any clues for when they might look to tighten monetary policy, or even just run it less loosely. Central bank watchers may also like to study the latest beige book from the US Federal Reserve on Wednesday the 7th of March. That's an anecdotal study of American economic conditions, and then they'll be particularly homing in on the monthly non-farm payroll, unemployment and wage growth figures from the USA on Friday the 9th. After all, a lot of the blame for the stock and bond market stumble in early February was placed at the door of January's 2.9% year-on-year increase in American pay packets. That was seen as a possible trigger for more and faster increases in American interest rates. This chart here shows how the US has added an average of 171,000 non-farm jobs a month since January 2017, although the monthly number is a volatile one. This next graphic then shows American unemployment over the last 5 years on a monthly basis and how wage growth has possibly started to gather pace. Although that January 2.9% growth figure may have been a bit of a funny one. 20 cities and 18 states in America increased the minimum wage as of the 1st of January. The state of Washington went as high as $10.40 an hour against the national minimum of $7.25, and Seattle went all the way up to $15.45 an hour under certain conditions. Now, let's get back to the UK's corporate reporting season. Statements and results worthy of note include those from newspaper publisher Trinity Mirror on Monday the 5th of March, equipment rental giant Ashtead, brickmaker Ibstock and Intertech on the 6th, Rolls-Royce, life insurer Legal & General and bookmaker Paddy Power Betfair on the 7th, another life insurer Aviva and G4S on Thursday the 8th, and acquisitive bookmaker and gambling service operator GVC on Friday the 9th, and its current bid target Ladbrokes Coral hosts an analyst meeting on exactly the same day. But for me, the one name really capable of causing a fuss is Just Eat, when the online food ordering and delivery service reports its full year results on Tuesday the 6th of March. The results represent the first chance for new Chief Executive Peter Plum to address the market. The former Money Supermarket boss took over last September from interim chief Paul Harrison, who in turn stepped up following the ill health and then ultimately untimely death of executive chairman Dr. John Hughes last year. Just Eat only floated on the London Stock Exchange in April 2014 at 260p a share, but the stock has since surged to almost £9 a piece, and the 5.9 billion market cap took the company into the FTSE 100 last December. In fact, its market valuation now exceeds that of Sainsbury's or Morrison's or Marks & Spencer's, for example. This shows how the internet places a focus not just on price but on service, and Just Eat's success is testimony to its ability to harness the power of both technology and consumer satisfaction. Its asset-light model relies on partners, word of mouth, customer reviews basically, across a dozen countries, as well as its scalable platform, which is an example of how the internet can be used to create a powerful and profitable business model. Now, analysts expect the company to generate pre-tax profit of £136 million in 2017. That's up from £91 million in 2016, as we can see here. Now, that figure is way below the £572 million, £558 million and £375 million expected of M&S, Sainsbury's and Morrison's on an adjusted basis for their current financial years. Those companies may be more profitable, but Just Eat is valued more highly as the market is clearly taking the view it's got superior growth prospects, and it is growth that Just Eat must continue to show. With a forward price earnings ratio of around 50 for 2017 and 35 for 2018, the stock is exposed on the downside if there's any whiff of a disappointment or slowdown. So, besides the headline pre-tax profit number, watch out for commentary on order growth in the UK, overseas and overall. At the third quarter stage, UK orders rose 22% and the group total by 29% to 43.1 million. Look at active users and partner restaurant numbers. They were 19 million and just over 75,000 at the first half stage. And also look at average revenue per order, which was £2.84 in the first half. Also check out any comments on progress at recent Canadian acquisition Skip the Dishes and the purchase of British firm Hungry House, now that that deal has been cleared by the Competition and Markets Authority. Thank you for watching, and I look forward to seeing you next time.